Hello everybody, Brian here from quantlabs.net. Today in this video I want to talk about a couple of, call it machine learning techniques, specifically for crypto trading. I put up an article earlier today regarding statistical information on, let me just find it here. It's called "What Does Statistics Say for a Crypto Trading Bot?" I made a video on that here explaining what I'm seeing between 24, 4-hour, 3-hour data and a relationship that I'm seeing and how we can analyze a long opportunity. So how to analyze that, how do you exploit that pattern, and then be able to build methodologies to do forecasting with that. So here I put this very important, profound statement in here from somebody who said, regress them all against price or conduct a PCA. Perhaps you could just throw them all into a random forest in order to see which ones are most important. So that's what I'm going to look at. I'm going to first look at random forest and my interpretation of it. Maybe some might not like this style, but whatever. Don't watch that, I guess. All right, and the other one I'm going to do in the same video is random forest and regression. So I'll do those right now. So one of the things I mentioned in this article is a package for Python called Psychiclearn. I've in the past talked about a lot with TensorFlow, PyTorch. I think those libraries or packages, Python are very complex. And they take up a lot of resources in terms of running the different tests that you need to do or simulations. So I'm going to try to keep it as simple as possible, get the fastest that I can find. And the simplest one right now is definitely Scikit-learn. Eventually, maybe if you get better at this, move to something like PyTorch or TensorFlow down the line, run on the cloud, I'm sure you know what that is. Okay, let's first talk about random forest. So there's this article on towardsdatascience.com, article random forest in Python. So that's pretty straightforward. This is a really good article. Talks about the roadmap and how to use this stuff. So what we first got to do is data acquisition. As you know, with what I showed in that last video, there's a lot of data to work with, standard deviation, just descriptive statistics, which really helps. Okay, and that's just built off of a simple open, high, low, close bar. And there's quite a lot of data, I would think, to work from that. So that's what we got to figure out. Quite a good article, reinterpreting missing data. And what to do about it. And so here he talks about data preparation. Obviously, the timestamp is what you could commonly use. The price maybe, and all the derivatives that come out of that. But this is the one hot encoding he's referring to, like day of the week. But the timestamp's what we would all use in a Unix timestamp format. And talks about that. Now, this is the interesting thing. So we need to identify our feature of what will maybe help determine the end price. So obviously our target will be the price itself, the closing price, but can we also maybe use the entire bar, like the open, high, low, close, as an end target? Obviously, most people put the focus either on the midpoint between the open and the close, or they just use, in my case, I just use the close because it's simpler, but I do know pros will use the midpoint between the open and high, and then look at the lows and lows, the high and highs, all that stuff, but that's part of what this process will tell you that. And then we factor out our features, so again, that could be potentially all the descriptive features that come out of what I showed in the previous article on the statistics. So all the descriptive statistics itself, meaning volatility, the mean price, the number of frequencies over a time frame. You could also add in, if you really wanted, different multi-times as well. But I think when it comes to crypto, there's really no, I mean, there's patterns, but the patterns and the relationship of a performance of a particular coin realistically may only last 3 to 4 hours, and it can come and go, and then it can come back in 6 hours, 6 days, or 6 weeks. So there's a lot of randomness there. So from what I'm seeing, I think it's just better to keep your time window of analysis for about 3, maybe 4 hours at the most, and that's it. That's what I'm seeing, at least. And then we got to convert all that data into typical arrays. I'm used to NumPy arrays, so this guy goes through that, blah, 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 blah. This is a very interesting statement here. Establish your baseline, which totally makes sense to establish what your metric will be. As I said in my previous video, your metric right now, it could be invalid in a week, in 3 weeks, 3 months, who knows. But right now, from what I'm seeing over the last 2 weeks, the crypto market has tightened up so much that everything, the 23 coins that I look at through the Binance futures, they all go together. But when I look closer at the statistical data, what I'm finding is there are pairs that will outperform the Bitcoin metric. So we could just make a simple statement saying, why don't we use Bitcoin as the metric that we want to use to see if this outperforms that, as one way to do it. And another way to do it is, as I said before, is to use what I call, oddly, the break-even, right? So the break-even would be, if you're looking at from a descriptive statistical standpoint on the number of positive returns and number of negative returns over, let's say, a 5-minute time frame or a 1-minute time frame, which I'm going down to now. You only focus on the one that baseline would be established for that time period of the baseline would be where you would say, okay, we have an equal number of positive and a number of negative moves over that time period of, let's say, 3 hours, 4 hours, wherever I set it at. Everything else would be outperforming. So that could be another way to use the baseline, and then only focus on those that are outperforming that baseline. So in this case, the 4 here, which would include Chainlink, XMR Monero, Binance B, which is Binance Coin, and XLM, which is the Stellar. And then everything else after that is just not performing at all. And only focus on those 4 for the time being, and do all this machine learning analysis, whichever methodology I go with, as what I will assume is the outperformer, if that makes sense. So in this example, basically, I'm using XTZ or TZOS as the as the baseline, because it has right there the equal number of positives and negative returns. That's what I'm seeing might be the most logical. And then anything above that, you just look at as outperforming. Okay, so we'll leave it at that. It's quite the mouthful. So the next step would be to train it. So then we do all of these training, and then here's the key, is making the predictions against the test set. So essentially, if we pick out of these, we actually have, so we'll go with this one, TZOS, XTZ USDD, as the baseline. So everything else below this, we just throw out. So we'll only focus on XTZ as a baseline and figure out if we can use these 4 that I mentioned, Chainlink, Monero, BNB, but Binance Coin, and XLM Stellar as the performers, and only analyze those and only make predictions off of those data sets. Okay, and then we make predictions. Then we determine the performance metrics, and again, this is all using This is Scikit-learn, and see if there's ways to improve the model. I don't think there would be, maybe, and then interpret them. And then what we can do here, this is the interesting thing is with random forest, is look at what we have here. This very huge number of values. I wish you could see it. I don't know why. Oh, actually, there's a better one. So that's what we can look at and generate all the different nodes, I guess, within that decision tree. Okay, so it says here limit the tree level to 3. In this case, okay. So let me get back to where I was. Okay, so all right. So we do the baseline, and then here we interpret, model, and report the results. Okay, so here we can generate these different trees, which is pretty cool. But this is essentially what we're doing in a nutshell. Is we have a root node, and then we can give it the average, and then these different RMSA samples and the value of that prediction, and build out somewhat of a tree out of that, and then go through this whole rigmarole and know what works, what doesn't work, and compare it against the real data. So it's kind of like another way of saying we're doing back testing here. And then if you want to visualize it, so here, this is really important because if we feed it all this data, all these features, or in the world of trading, as they call it, factor modeling, be it like let's say you're going to analyze a stock, you're going to add in the things like guidance, EPS, things like that. Like that's forward indicating, or a lead indicator, right? So that we can determine using random forest, we can determine what are going to be the most important factors to use. So in this case, we have temperature 1. That would be the most important one that we need to rely on, and a breakdown of what parameters we can use that are going to help determine to get the better predictions. Okay, and that is powerful. Okay, and then we can chart from this where we have the actual and the predicted result, and then on top of that, we can go further and average it all out. It's pretty powerful in that retrospect. That's why from what I'm seeing here, random forest is really good because in 2 articles I've listed, this is like an end-to-end complete tool set you can work with random forest and doing these type of forecasting for the needs that I want to work with when it comes to predicting price. And here's the question. So going back to the spreadsheet here, we have, let's say, 4 of these crypto coins outperforming our established baseline at this XTZ. What I'm figuring, depending upon your analysis on your time frame, in my case, I'll probably analyze 1 minute. With Binance, I can get 1,000 rows out of that, and that will last me between 15 to 16 hours of minute data, which is really good because realistically, like today being Wednesday, whatever happened in the market yesterday or Monday, it don't matter. What I care about is what happened most likely in the last 4 hours, or the last 12 hours, or the last 24 hours, 1 day at the max, because there will be some momentum built around certain coins, as I showed in my previous video. That's important. What happened yesterday or the day before doesn't really seem to matter. And that's the importance of crypto. So knowing that, and from what I'm seeing, your best time frame and opportunity to see those relationships usually will, from what I'm seeing, will last anywhere between 3 to 4 hours. I don't think it really matters. So what I'm saying is, if you use this kind of methodology using minute data, what you could do is with the random forest, feed it 15 hours, 16 hours of data, of minute data. That's your whole entire data set, and then factor maybe 3 hours of that data. So let's say 30% of that data might be useful to forecast against real historical data over that 15, 16 hours. So you can do that, do this statistical analysis, do these predictions using random forests for the let's say the outperformers, in this case your 4, and then from there do the analysis, and then focus on what you want to trade, or based upon probability of what this random forest will predict, and then be able to make judgment calls on what will perform in the next 4 hours based upon this historical data, based upon this historical data analysis for that 24 hours, if that makes sense. And then whatever happens over the next 4 hours or next 24 hours, it don't matter, because it's all going to change based upon how the overall crypto markets work. Ooh. Okay, so that's a lot. So what I'm saying is you need to do this type of analysis and rotate everything every 4 hours, I would say. And the other problem is, let's say if you get a baseline of here out of 24, 25 coins, and your baseline moves down to here at position 18, now you have to worry about, let's say, 17 coins on how they'll move over the next 4 hours. Depending on, like, ideally you'd want to do them all, right? But if you have 17 and it takes you maybe, let's say, an hour or 2 hours to do 4, just focus on those top 4 that look good, that perform best, and just focus on the top 3 or 4, okay? And the other thing is, with this type of methodology, this is a mean reverting strategy. This is a mean reverting calculation. So when it just mean reverts no more than 1% up or down from the mean of, let's say, Bitcoin, you're okay. And that seems, from what I'm seeing, 90% of the time for the last month or 2 months. And then when the markets go crazy in terms of huge momentum moves, then you got the 2 other coins, strategies I've got that track momentum, because for the last few days it's not taking any trades, because they have their set of metrics that will enable you to take advantage of. But the problem is there's no opportunity there. So doing this kind of new strategy and trading idea will help most of the time. Like, it should cover about 75-80% of the entire crypto market and different types of market scenarios, unless it goes into a true random walk. From what I understand, that's no different than what you call a Brownian geometric motion, and then you're not going to make money there. But it's very rare. Look, like, you're going to get some mean reverting, be it 0.5% or a 1%, from, if you were to compare it to Bitcoin. All right, so that's a lot there for random forest. So let's go over to linear regression. Now, linear regression, I'm basing this on, again, towards data science article, Beginner's Guide to Linear Regression in Python with Scikit-learn. And Scikit, for those on the podcast, is SCIKIT-learn. That's the name of the package that we're using for these modeling techniques, because it's way simpler than something like TensorFlow. So this guy here talks about, is it a guy? Yeah, it is. So this person talks about what the theory of linear regression is. This is great for non-mathematical people like me, talking about this standard y equals mx plus b momentum. Talks about the different types of lines you can generate here based upon the average set of moves on the data that you use. In this case, I think it's weather, or was it the bombing one from World War II? I can't remember. It doesn't matter. Anyway, so you got all the libraries. Yeah, so this is using the bombing in World War II, which Air Force did what for the Allies. So that's the data we're using. So here, what they're trying to factor in: at what point should you go out and bomb? Do you bomb when you have minimum temperature or maximum temperature based upon a historical data set, and based upon that you'll forecast the days that you go out to bomb. And then from there you can generate these charts, your distributions, and then here what we're doing is we're kind of training it, or we're developing a training data set based upon the data set that we provide. And it's no different than what I talked about before. You could use, hopefully, just descriptive statistical information as your data. And then you do, I think it was like, let's say 80% of it. And then you can factor in what is the intercept and the coefficient of that line, of the slope, I should say. And that I'm referring to up here, which is this red line, which will change depending upon where your data lands. All right. So yeah, you get your training set. You can get your intercept and your coefficient of that line of the slope, and then you have your test. So no different than what you do in the random forest, but you do it 80% of the data set, and then you factor in 20% you have your full training set that you set up, all data used, right? And then from there, as I said, you get your intercept and your slope of that regression line that you're going to use, the red line. And then what you can do is, let's say you only want to do 80% of that data to predict with, and then you can compare that against the last 20%. So what you can do is you can get your predicted against your actual. And then from there, what you can do is you can kind of gauge how well that accuracy was in the performance. So in this case, what we have here in this chart, we have our blue actual and then orange of predicted. So it looks okay, but when it comes to trading and predicting price and your closing price, okay is not going to be good enough. You got to get it really close. So there's methodologies to kind of predict that, but then you get into these types of errors. I've given another article here on the errors on that accuracy of the predictions, and there's different ones, right? We have mean squared, root mean squared error, and I think there was an absolute, and then we have forecast error. Okay, so we have these different types of errors. We choose one, or we can figure out which one works best. And then here is, instead of having one time frame, let's say, in the world of trading, we could have, let's say this could be 1 minute data, using that as prediction. Now, as we add in multivariate down here, we can go, okay, let's do a prediction for 1 minute data. Then let's do a prediction on 5 minute data, 15 minute data, and hourly data, maybe 4 hour data. And we can combine them all together, as in here, to do multiple linear regression of different time sets, which is multivariate, if I got that makes sense. And then, I don't know, add to the confusion. So I'm going to be totally honest. I think from what I'm seeing here, regression, as I said, looks okay. But this is why I'm leaning towards random forest, because it's a lot less work. Plus, you got a lot more data that's needed. Well, you get a lot more output data, but one factor that I really like when it comes to random forest is this capability to play around with the predictor result on top of what I think is really important after you train the model is to figure out what metric is the most important out of all of them that you feed into your simulation. So let me just see where that would be. This I like, this tree feature. I really like that. But let me just get the chart here. It's probably better. Yeah, this one right here. So this will tell you which is the best parameter that you can rely on that gives you the best prediction. That is really important especially when it comes to trading, we'll say, because when you look at it, if you watch that previous video, I go, well, is the mean more important? Is the number of positions versus the number of negative more important? And then you have the standard deviation, which is the same as saying volatility. Which is the more important factor? And you can use that and say, okay, I'm going to rely more on standard deviation, or maybe rely more on mean, because it's a better indicator to you, or better parameter to use to get better predictions. And that I find is pretty powerful. And then you get all this other fun stuff as well when it comes to the prediction, and you have more control of it. The only question is how long does it take to run this is the question. Anyways, a lot of mouthful. I'm going to stop for now and move on to the next one, which is PCA. Hi, Brian here again. Let's talk about this PCA, principal component analysis. Is coming now from DataCam.com. Right now, looking at this, and when I went through it, I'm not a big fan of this particular technique. There's a lot of work to it to get a lot more work to get similar results as random forest. The one thing I do like about this, it's unsupervised, okay? And the other thing I like about it is you could take all this correlated data and be able to turn it into uncorrelated. So I'll explain here. Meaning, if I'm seeing all the pairs, all the crypto coins correlated around the performance of Bitcoin, the uncorrelated is going to be helpful to identify some hopefully different relationships that we wouldn't see otherwise. So, this is, from what I'm seeing, it's really good for looking at other data visualization and do predictions out of that. The one thing that I'll also say that seemed to be pretty attractive if you're really constrained with memory or processing or whatnot, this can be a good technique to use because it will speed up the machine learning algorithm training and testing, as long as the data has a lot of features in it, and the machine learning algo is too slow. So I'm not going to get into what this is. There's the link to this DataCam article. But the data they're using is breast cancer data. You go through this major exploration, and it's very, very, very involved. You could see here, you could reshape it, shape it, and then this will give you the list of features that you want to use. Obviously, you provide it, and then it will give you your overall data frame that you'll end up using. And then there's more data that this guy throws at it, and you just go through more and more. One thing I need to mention in here is it's using Scikit-learn, but it's also using Keras, which is now part of TensorFlow. So using this code might not be 100% compatible, if you are going to be using TensorFlow 2. So you might have to make modifications in the code here. So continuing along, we're going to plot some of this stuff. I guess it's for animal recognition, more data visualization, whatnot. It doesn't really go as far as random forest from what I'm seeing. I could be wrong, but that's why I make these videos, to have people give me feedback and saying, no, this is better because here, and maybe something I'm missing here. So here we get this explained variance ratio, which is kind of important because it'll give you how off you are on your forecast. If I could be wrong there, but that's from what I'm reading. But here you get a general. So you break it up either into two columns. Either in this case you have a malignant or benign. So you factor it into, let's say, in crypto buy or not buy, something like that. And here you now give it the complete data set, and then you get more features that are added, and then that will take you to this, which is similar to what you just saw, but just in more detail because you're providing all the data. So here we can speed up the deep learning with the PCA. So, just resizing it to a certain point you want in terms of a data frame gives you the actual model that's printed out. Now you train it, you get your results. And it's a totally different methodology to determine this model. But here you can see the training for each epoch took 7 seconds, which is pretty fast. So that's pretty good. Model did a decent job of achieving 70% accuracy, and only achieved 50%, 56% on the test data. So in my case, I don't know what the amount, around 90% accuracy, but 70%. Now it could be just because of the data and how you coded this up, might be a reflection. But either at the end of the day, it's a lot of coding and data wrangling to get to this point. So far, that's why I like random forest from what I'm seeing so far. Then try to fit the model, go through the same process. So it says took 23 seconds, which is still pretty fast. That is an impressive feature of doing this. So we look at the accuracy and all that fun stuff, and that's pretty well it. So out of the 3, PCA, regression, and random forest, I just like, from what I'm seeing, I like random forest because it's end to end. And in the previous click on why I really like it versus even something like PCA. But again, let me know your feedback. I'd be interested to see from a training perspective what people use and how they're doing it, where I'm wrong in any of this stuff, and let me know. Thanks for watching. Have a good day.